If you open a chart of the standard major pairs right now, you will see a chaotic battle. Retail traders and high-frequency algorithms are fighting tooth and nail over the exact same 5-pip margins. Pairs like the euro to US dollar are highly exposed to every piece of Federal Reserve news, sudden central bank announcements, and massive European debt cycles. It creates a tremendous amount of noise. This puts you in a tough spot. When the global economy is expanding and you want to trade that overall strength, you usually have to accept the wild swings that come with those major pairs. But there is a cleaner way to trade global growth. It lies in the commodity cross, AUD CAD. Escaping the market noise means stepping away from economies weighed down by federal debt and looking at two economies anchored by the export of physical raw materials. In Forex, we call these commodity currencies. Think of Australia and Canada as two equally matched athletes. The only real difference is what they eat. For Australia, that diet is industrial metal. The country is the world's largest exporter of iron ore, shipping millions of tons to international buyers. Because so much of that ore goes straight to Chinese construction projects, the Australian economy practically functions as a highly liquid proxy for China's industrial sector. This chart shows Chinese manufacturing PMI overlaid with the Australian dollar. When Chinese manufacturing signals expansion, iron ore demand spikes, driving the currency upward. Inversely, if construction cools, lack of demand removes support, pushing the trend line down right alongside it. To understand where the Aussie is going, you have to look past local domestic data and treat the currency exactly for what it is, a real-time thermometer for Chinese manufacturing. Canada runs on energy. It is one of the world's largest oil producers, relying heavily on sprawling refineries and the steady export of crude. That means the Canadian loonie is strictly linked to the price of Western Texas Intermediate crude and heavily dependent on the U.S. economy, which buys the vast majority of that oil. This sets up a clear dynamic. If supply constraints cause oil prices to jump, the Canadian dollar strengthens and outpaces the Aussie. If iron ore is booming, the Australian dollar pulls ahead. When the global economy expands, both materials are in high demand. The iron-backed Aussie and filters out wild spikes, creating slow trends and well-defined limits. A perfectly stable chart is rare in Forex. Here, it is the mathematical result of a continuous global tug-of-war between industrial metals and energy resources. Because these currencies spend so much time moving sideways in tandem, this pair is highly effective for a mean reversion strategy, which simply means betting the price will eventually return to its historical average. On this 4-hour AUD CAD chart, price is trapped between horizontal support and resistance. We apply a 20-period Bollinger Band and a 14-period RSI. Your entry triggers precisely when price touches the upper band, just as RSI pushes above 70 into overbought territory. From there, you execute a short entry. You place a tight stop loss just above the recent high and set your take profit target near the lower support band. Mean reversion works reliably here because those underlying iron versus oil fundamentals are actively fighting to keep the price from breaking out of that channel.
Here's the formula for calculating pip value on a standard lot. If your account is in US dollars, your profit per pip depends on the USD to CAD exchange rate. You must size positions to maintain your standard risk profile. Timing is equally important. The fundamental data driving these currencies happens in completely separate time zones. Australian interest rate news hits during the Asian session, while Canadian data drops during the North American session. The optimal window for that mean reversion strategy is actually the quiet dead zone right after the European markets close and directly before the Asian markets open in Sydney. During this gap, volume drops, reinforcing technical support and resistance levels. The boundaries hold firm. By mastering the balance between iron and oil, you gain a clear, professional window into global industrial health. Open your FXNX account today. Pull up a weekly chart of the AUD CAD. See how clean these ranges are for yourself, and take advantage of institutional-grade 0.0 pip spreads.